Hey guys, welcome back to my channel. Today, I'll be sharing some valuable insights on how to manage risk in Forex trading. Risk management plays a crucial role in trading, and it's essential for all traders to prioritize it. Without proper risk management, the chances of losing money outweigh the possibilities of making profits. So let's dive into the world of risk management and explore effective strategies to protect your capital and maximize your potential gains. If you are new to the channel, subscribe so that you don't miss future videos. Also see the description box if you also want to download free Forex courses, books, and trading tools. Many people ask me about the broker that I use. See the link in the description box. What is risk management in Forex trading? Risk management in Forex trading revolves around controlling your exposure to potential losses. In this context, risk refers to the likelihood of losing money. Several factors contribute to the overall risk, including market volatility, position size, and your trading strategy. The importance of risk management. Understanding the importance of risk management is vital for traders of all experience levels. Implementing effective risk management strategies is crucial to safeguarding your capital and preventing significant losses. Even if you're a skilled and profitable trader, inadequate risk management can lead to substantial financial setbacks. Effective risk management strategies for Forex trading. Now, let's explore some practical tips to manage risk effectively in Forex trading. 1. Set stop losses and limit orders. Utilize stop losses and limit orders to automate risk management. A stop loss order automatically closes your position if the market moves against you by a predetermined amount. On the other hand, a limit order opens your position when the market moves in your favor by a specific amount. These orders help mitigate potential losses and protect your investments. 2. Leverage, a double-edged sword. Leverage can be a powerful tool to amplify your profits, but it can also magnify your losses. Use leverage wisely and avoid overexposure to mitigate the risk of substantial financial setbacks. Remember to assess and understand the potential risks associated with leverage before incorporating it into your trading strategy. 3. Develop and follow a trading plan. Having a well-defined trading plan is paramount to effective risk management. Your trading plan should include your risk tolerance level, trading strategy, and clear exit criteria. By adhering to your plan, you can make informed decisions and minimize impulsive trades driven by emotions. 4. Emotions in trading, a dangerous mix. Maintaining emotional discipline is crucial for successful trading. Avoid making impulsive decisions based on fear, greed, or other strong emotions. Emotion-driven trades often result in poor outcomes. Stay calm, objective, and rational in your decision-making process to reduce the risk of unfavorable trading results. In conclusion, risk management is an essential aspect of Forex trading. To ensure long-term success, traders must prioritize effective risk management techniques. By implementing the strategies discussed in this video, you can protect your capital, minimize potential losses, and increase your chances of achieving profitable outcomes.